Hello, hello. So PDD or PinDUODUO is actually very cheap right now. The P ratio of the company is less than 11, actually about 11, and the stock price has been kind of going down through the past few months, I suppose. But if you take it back to like 5 years, it's been down quite a lot. So I think it's like for yeah 50%. So is this a good opportunity for a buy? This is what we are going to talk about in the video, and there are many things to talk about. And you will notice again that the price to free cash flow, for example, is fairly low here at 8 for the company. Very few liabilities that the company has, little debt pretty much, and the revenue, net income, total equity, and all that have been going up for the most part. Now, the margins of the company are a little bit concerning here, and we'll talk about this because they have been going down steadily through the past few years. And this is not only about increased expenses, pretty much, but it's actually a little bit of a worsening operations, pretty much. So, still, it's not like bad. It's like about 57% for a marketplace, pretty much. And so it's still important to recognize that, though, like when you examine the financials of the company, even though the actual margins are relatively steady, kind of a little bit declining in the latest quarter, but still are sitting around like 25 to 30%. Now, the company has very little debt, again, as I mentioned earlier, almost no debt here, which is very nice to see, and solid returns for such a company. Now, remember, PinDUODUO is almost like Amazon, but it's not a direct retailer. It's like a platform, so it actually connects buyers with sellers, pretty much. Now, if we examine the income statement of the company here, we will see some finer details which are extremely important. And the thing that you will see is that the total revenue of the company has been growing tremendously. This is very, very, very interesting here because it used to be like 2 billion back in 2018 and now it's 57. So the growth has been insane. So the revenue growth here at some years has been doubling and then 60%, 80%. Now, when we are sitting at 57%, you will see that it has been going much more slowly. And this is why it has been suffering a little bit in the latest quarters, as you can actually also see here in the quarterly reports. The latest quarters haven't been amazing, and this is why it has dragged the company down a little bit, even with a little bit of a decline in one quarter here compared to the previous one. But overall, solid increase for the company. And again, let me go back to the annual because that's important. If we go back to the annual, you will see that the net income is also kind of a similar story here, which has been growing and it used to be negative in some years in the past, like 2018. Now we're sitting at 14 billion, so the company has been sitting nicely. But notice that they have been going down a little bit. So again, that's something to say. Has to play with the margins also that are getting a little bit worse. Okay, so the next thing to examine and we want to see in detail is the AI deep dive, which gives us information about the company's internals, but sort of like in an articles type situation here, where we can actually see what the company has been doing. Now, revenue grew 9%, but profits are tanking because the operating margins have collapsed, what I told you earlier. And you will see that sales are up, it's okay growth, but nothing to write home about, again, compared to what has been happening in the past. And so expenses have been jumping here, and this is why you are getting operating income that has been, margins pretty much have been going down a little bit. Now, you will see that the company is making also a ton of money from interest, as it is propping up the bottom line, as you'll see. It's interest and investment returns, pretty much. And this is about 30%, which is a lot. Meaning that a lot of the company's net income doesn't come from the operations, but it comes from investments. And you don't want to see that, generally speaking. Like you like that, of course, but you have to take it into account because you want your company to be making money from the company's operations, not from being a shareholder. You get what I mean, right? We're not buying an investment company here. That's not bad, but it's worth noting that they have a lot of it, like 30% of the quarterly net income was from this. So it's worth noting for sure. Now, you will see that other important things here is growth is slowing actually, and the company doesn't really report some metrics here about users and engagement and things of that sort, which leave things a little bit more blind for investors. You kind of can counter this by saying that a lot of companies don't do that anymore. Because it's very volatile and it introduces situations where investors hang up too much on this one and they can bring down the stock for no good reason, pretty much. And so, being so volatile, I can understand that. Now, R&D has jumped. Again, the company has been spending a lot, is what we talked about earlier. And the other interesting things here that you can see, the multinational label brings local targets. I believe this is about Temu here, which is a big thing for the company, obviously. But you do know that they also have some regulations happening in Europe potentially, and some extra taxation that is also happening. Now, what I noticed here is that there is some dilution bill here, pretty much share-based compensation, a recurring expense here, and is material and excluded from non-GAAP. That's what a lot of companies do actually, inflating adjusted profits, so worth taking a look at. Now, the key stories, which are very interesting, is that the company has a huge pile of money, but profit depends on the stock market, what I told you earlier. A lot of investment income here. Sales are growing a bit, but profit per sale is tanking. The margins that we talked about are suppressed a little bit. And loaded with cash, but they aren't sharing it, so they're choosing to dump their extra cash back into helping sellers and tech research instead of giving it back to shareholders. So they're not really buying back shares, is what this article is telling us here, which may not be a great situation. I'll talk about it a little bit, but let's examine this one first. They are hiding the details while risks pile up. The regulatory risks here, since the numbers that they are not actually reporting anymore, as I told you earlier. So, the thing that I wanted to talk a little bit about is the fact that the company actually has a very low PE right now, sitting at, again, as I mentioned, like 11 here, and it's been going down steadily. And this may be a fine situation for buying back shares, because they have been issuing shares. Like you will see, for the most of the part, they have been issuing like 11% extra since 2021. So this would be a prime opportunity to buy as the company is going down. It would also signal that the company believes in its own self, pretty much in itself. And so I could picture in the upcoming quarters, especially if this goes down a little bit more, or if it stays steady for a while, that they could be issuing some share buybacks. And this could actually prop the stock price to go up. And it would make a ton of sense to me, as long as they expect their operations to do well, to keep doing well. And again, you can see a little bit of suppression, but it's a very solid business and a very cheap right now business. So I like what I see for the most part. Now, I'll take a look at the stock alerts as well. They give us a little bit of a story about what the company is doing, and for the most part, these are fairly fine, is what I saw earlier, with the margin trends going up, incremental margins also going up, as you'll see here, from 27% current operating margins. The incremental ones, pretty much for every $100 more extra revenue for new sales, how much of it is profit, is what this is telling us. The new one, by the way, it is incremental. And so this is getting better. And the earnings quality is very solid here. The free cash flows quality is solid as well. Owner earnings, of course, it's still, again, fairly solid. Share dilution is happening, and we saw that. This is a little bit of a bad thing, but it's getting a little bit better here, like stabilizing itself a little bit. And the stock-based compensation of the company is spending a little bit less than they used to, which is nice to see overall. Receivables quality and accruals quality is also fairly solid here. And depreciation, they don't really have such issues because they don't even have inventory for the most part. And actually, or I should say, they don't even have like a lot of capital expenses in that manner that would require depreciation, and pretty much they have assets that they're depreciating fast. So these benchmarks for them are, sort of like a meaningless situation. And obviously nowhere near any bankruptcy or any manipulation here in the books. So fairly solid is what I see here for the company. I like what I see. Now, I will also do the stock evaluation, which we can understand for regular numbers, it will probably produce some value that is fairly higher than what the company's stock price is right now, which is sitting at about $100, which I consider fairly cheap based on what I've seen already. And you will see that the company also signaling a turnaround. Actually, the tool recognizes this because it was unprofitable. And so you will see that the last profit year, the first profit year was 2021, and the growth since then has been tremendous, is what this is telling us, which is very nice to know about what has been happening with the company financials through the years. Now, some values actually the company doesn't really report. I noticed that they report a lot of free cash flow, for instance, annually and not in quarters, for instance, which is fairly typical because this is a company that files, it's a foreign filer, so they don't have to even report a lot of these things at all. and so this is why some of these numbers are basically not even there. And you will notice that because of the averages, like the average here of revenue growth of the company is about 65% in the past 5 years, propped up by the fact that they started low and they kept growing very nicely. So you will notice here that we have very, very increasing revenue. But I can't really use this kind of growth, because if I go with this kind of growth, we will get tremendous values here, and they won't really make sense, because we don't really expect the company to grow at 80%. But this adjusts based on the averages, this scenario here. If I used like the Warren Buffett conservative, it will go much lower, because it accounts for the fact that the company slows down. So it really depends on what kind of scenario I use. Like the deep value vulture here tells you exactly the philosophy here. Like, buy troubled companies, they're cheap, assume things stay bad or get worse, which is a situation that I like to examine. Like in this case, we're looking at a company that could actually have some deteriorating position, and you could see them, having this type of lessening growth, for instance, in the future, sorry. And growth at any price is another one here, which obviously we don't want to use. So there are a lot of different models, for instance, but I'm going to go with the Lucky 13 pretty much, my signature one, and use lower revenue growths. So I'm going to go something that makes more sense, like 15, 20, and 25. I think it's fairly solid for this kind of company, and they can do it for the next 5 years. And so we will calculate and see what we get for the company's pretty much valuation here, and even with the required return of 13%, which is fair and what we should be asking for. All these are green here. So the company is undervalued in terms of its cash flows, that's for sure. And even if we go, I think with a Warren Buffett conservative here, you will more than likely still see green everywhere, because it's just too cheap. So these are the things that happen with this company. I like what I see, and as you'll see, green again. So I like what I see. In my opinion, this is a buy for the upcoming years, because they don't really have a stressful situation, frankly. There are some problems, some worsening stuff, like the margins, for instance, some pressure in their margins and operations. But for the most part, it's not like that they are tanking. It's just that they used to be expensive, and the Wall Street doesn't really like the current situation right now. Is the big deal about them. But I think it's an overall buy. Let me know what you think in the comments below. I'd love to hear your opinions, and thank you for watching, guys. See you soon. Bye bye.